Wouldn't a little simplicity in your life be nice? Imagine one ticker symbol that holds almost all publicly traded companies in the US. And that's what we'll be discussing today, the Total Stock Market Index Fund.
This is the LawyerFi podcast, equipping lawyers and other high-income professionals to reach financial independence. Adam B. Cordover is a Florida-based collaborative family law attorney. He is not a financial advisor, accountant, or tax attorney. This podcast does not provide legal, financial, or tax advice, and is for information and entertainment purposes only.
Welcome to LawyerFi, the podcast that empowers lawyers and other high earners to build lasting wealth and reclaim their time. I'm Adam B. Cordover, a Florida-based collaborative family law attorney, and today we're exploring how a total stock market index fund can serve as the dependable core of your investment strategy. Through the course of this episode, you'll hear a quick history of index investing, a breakdown of how total market funds differ from the familiar S&P 500. J.L. Collins celebrated VTSAX and Chill philosophy, a head-to-head cost comparison of popular tickers, and even a look at a few lazy portfolio options. By the end, you'll understand how to keep more of your hard-earned billables by running a streamlined, low-cost portfolio you can manage yourself. So pour a fresh cup of coffee, close the billing app, and let's draft the simplest, most powerful brief your financial future has ever seen. So let's talk about the history of index investing. Let's rewind to 1976. John C. Bogle launches the first public index fund, tracking the S&P 500, which contains stocks of around 500 of the United States' biggest companies. This went against the grain as other financial gurus offered lofty promises of beating the market, not just meeting the returns of the market. Wall Street laughed, calling it Bogle's folly because who would aim for average? Yet average ends up beating most pros once fees are counted. Within a decade, the data was clear and big pensions started piling in. And fast forward, the cost war begins. Expense ratios that once hovered around 1% drop into single-digit basis points, mere pennies per $100 invested. That fee collapse is the real story. It's why broad market indexing now wins 9 times out of 10 in long-term comparisons. The next leap came in 1992, when Vanguard rolled out its total stock market fund. Same indexing idea, but instead of the 500 largest companies, it owns virtually every publicly traded firm in America, from Apple all the way down to a regional toolbox maker. One purchase, the whole market. Today, trillions of retirement dollars sit in total stock market funds, and the low-fee model has spread to every major brokerage. The lesson is simple. When costs fall to almost nothing, owning the broad market becomes very hard to beat. So that's the history in a nutshell. Bogle's folly to a near unbeatable model, all powered by near zero costs. Now let's peek under the hood of what actually lives inside a total stock market index fund. Imagine opening a single file cabinet that holds every publicly traded company in the United States. That's what a total stock market fund owns, roughly 3,000 to 4,000 businesses, depending on the index provider. Giant names like Microsoft and Nvidia get the most weight because the fund is market cap weighted, which simply means each company's slice is set by its share price times the number of shares outstanding. When a firm grows, its slice expands automatically. When it shrinks, its slice contracts. The market does the sorting for you. That automatic process keeps turnover, the amount of buying and selling, extremely low, often under 3% a year. Low turnover matters because every trade costs penny in spreads and potential taxes. Fewer trades, fewer costs, more money in your pocket. Now, one of the most important lines to look at when evaluating total stock market funds, or really any other security, is the expense ratio. Think of it as the fund's annual retainer. Most broad market index funds now charge somewhere between 1.5 and 4 basis points, or 1.5 to 4 cents for every $100 you invest. So If a fund has an expense ratio of 3 basis points on $10,000, that's only $3 a year. A typical actively managed fund might charge 60 basis points. That's $60 on the same 10 grand. Stretch that gap over a $100,000 portfolio and suddenly you're paying $1,900 or more per decade for the privilege of trying to beat the market. This is not even counting financial advisory fees if you're leaving your funds to be managed by a financial advisor, or the taxes for the high turnover in an active managed fund. History says the market wins the vast majority of the time, and in fact, there's an inverse correlation between the amount you pay in expense ratio and the performance of the fund. In other words, generally speaking, the more you pay in an expense ratio, the worse the fund is likely to perform when taking into account fees and taxes. Because the index owns everything in proportion, sector weights naturally track the real economy. Tech booms, its share grows. Energy rebounds, its slice fattens. You don't have to rebalance sectors or chase trends. It happens under the hood. So the recipe is simple. Thousands of companies, cap-weighted, ultra-low turnover, and fees so small you need a magnifying glass to find them all. In a moment, we'll see how J.L. Collins turned that simplicity into a full financial plan, and why most active funds still struggle to keep up. When most people hear investing, they imagine stock tips, complicated charts, and a morning routine glued to CNBC. J.L. Collins looked at all that noise, considered his daughter, who didn't want to learn anything about investing, and asked, what if you just owned the whole U.S. market and maybe a bond fund and didn't have to think about anything else? This was key to his best-selling book, The Simple Path to Wealth. Collins leans on 3 pillars. First, diversification. You don't have to babysit. If one business tanks, the market barely notices because you own 3,000 plus other companies. Second, rock bottom costs. When Collins started investing in the late 70s, a 1% fee was normal. Today, a total stock market fund charges less than a tenth of that. On a $500,000 portfolio, the difference is roughly $5,000 a year. Money that stays in your pocket and compounds for you, not the fund company. Third, emotional simplicity. With a single market-wide fund, you can't chase hot sectors or bail on cold ones. You already own every winner and every loser in their exact proportions, so tinkering adds nothing but anxiety. Does the data back him up? Yes. The latest S&P Indices versus Active, or SPIVA, report shows that over the past 10 years, about 84% of active large cap funds trailed their benchmark. Stretch that window to 2 decades and the figure climbs towards 90%. The math shows low fee indexing beats most active funds before the race even starts. So if you crave fewer decisions and better odds, Collins' playbook is clear. Buy the market, pay almost nothing, and get on with your life. Next, we'll compare that all-market approach with the S&P 500 and other core funds, so you know when broad really is better. Let's discuss a common question. If an S&P 500 fund already owns the giants, why bother with a total stock market index fund? The short answer is breadth. Roughly 80 cents of every total stock market index dollar is identical to the 500 biggest names. That extra 20 cents picks up mid and small cap companies, the regional banks, niche manufacturers, and software outfits that might be tomorrow's household names. Day to day, you won't notice much difference. Over the past 5 years, the two indices have moved almost in lockstep. Correlation north of 0.99. That tight link exists because the top 100 companies alone make up roughly 70% of U.S. market value, so their swings dominate both indices. When small companies enjoy multi-year hot streaks, think the early 2000s or late 1970s, the total market quietly inches ahead. Best part? The fee is the same 3 or 4 basis points. You're getting thousands of extra stocks essentially for free. So what about the one-ticket funds your 401k menu pushes, such as target date funds or total world funds? Well, convenience is their superpower. One purchase gives you stocks, bonds, and sometimes foreign shares, all rebalanced automatically. Inside a tax advantage account like a 401k, they're terrific. In a taxable brokerage, though, they can leak value because the bond slice throws off interest and the foreign slice may distribute short-term capital gains. So here's an easy litmus test. In a 401k or IRA, a well-priced target date or total world fund is perfectly fine. In a taxable account, separate index funds usually win. A total stock market fund, a standalone bond fund, and if you like, an international fund let you control where taxes land. We'll devote upcoming episodes to a deeper dive on these fund of funds and another show on asset location, deciding which asset classes belong in taxable versus tax-advantaged accounts, so you keep more after-tax return. Bottom line, a total stock market fund gives you broader coverage than the S&P 500 at the same microscopic cost, and separate funds beat one-ticket funds in taxable accounts. Next, we'll pick the version of the total stock market index fund that fits your brokerage. No surprise fees, no headaches. Choosing which version of the total stock market to buy feels like picking a lane on the freeway. Pretty much the same destination, you just want the lane with no toll booths and smooth traffic. At Vanguard, the mutual fund symbol is VTSAX. It has an expense ratio of 0.04. If you prefer an exchange-traded fund or ETF, or you're at another brokerage, you can use VTI. Same portfolio, 1 basis point cheaper and commission-free at most firms. Now let's talk Fidelity because that's where I keep my taxable brokerage account and some other accounts. Fidelity offers FSKAX at a rock bottom 0.015 expense ratio. Only 1.5 basis points. Good fun, no minimum. Even so, I often buy VTI inside my Fidelity account. Why? Well, breadth. VTI holds just over 4,000 companies. FSKAX, on the other hand, tracks about 3,800. That extra 200 plus names is a sliver of added diversification. So I lean toward VTI when the trade is free. Both work, I just like the wider net. Fidelity also touts a zero-fee fund, FZROX, but one thing to keep in mind is that you can't directly transfer it to another provider such as Vanguard or Charles Schwab if you decide to change providers. Now that doesn't matter so much if it's in an IRA or HSA. You can liquidate it or swap it for a transferable fund. But in a taxable account, I avoid it because selling would trigger capital gains. Over at Schwab, where I also have an account, the mutual fund choice is SWTSX. The expense ratio is 0.03. Schwab also has a total stock market ETF, SCHB, that costs the same. If your 401k menu doesn't list any of these symbols, look for a U.S. equity index or a U.S. all-cap index fund. Alternatively, if those aren't available, it is okay to get the equivalent of the S&P 500, which might be called a large cap index. Because the S&P 500 and the total market move almost in sync, that large cap index is a perfectly good stand-in when a true total market option is missing. So let's talk about 1, 2, and 3 fund portfolios, and let's imagine this to be similar to a meal. Picture your portfolio as a meal you cook once and then leave to simmer. How many courses do you really want on the table? Well, let's look at a one-course meal. Start with a hearty stew, your total stock market index fund. It already has virtually every ingredient in the U.S. economy. This oftentimes, again, is called the one fund portfolio. For young lawyers or other high earners with decades ahead, that single pot can be enough. Max flavor, zero fuss. The downside, well, when the market sours, and it does sour every once in a while, the whole bowl goes flat. 30% down means your entire dish cools down by the same amount. So let's try a 2-course meal. Let's keep the stew, but add a side of bread, your broad U.S. bond fund. Bread doesn't spice things up, but it soaks up the excess heat. This is called a 2-fund portfolio, the total stock market index fund and a bond index fund. Now, stock to bond ratios vary widely. J.L. Collins has said that he's at a 75% stocks and 25% bonds ratio, which is very aggressive for someone in his 70s, but perfect for his risk tolerance. Others his age flip it, 20% stocks and 80% bonds, because they value calm over kick. Choose the ratio that lets you finish the meal without indigestion, or in other words, stay in the market. Refill the bread basket once a year or whenever the balance drifts more than 5 points. Now let's look at a 3-course meal. Let's serve that stew, keep the bread, and add an international side salad. In other words, a total international index fund. This is called a 3-fund portfolio, and it's what's preferred by the Bogleheads community. This third dish brings flavors from Canada to Korea, about 40% of global stock value. Use fresh contributions to keep each course in proportion so you don't create taxable leftovers. Now, which option suits you? Well, ask, at what market drop would I push the plate away or sell my holdings? If a wild roller coaster doesn't faze you, 1 course works. Need steadier nourishment? Add bonds. Want global flair and additional diversification? Plate the salad too. Take some time and look into these 3 options a little bit more and jot down what you think works best for you. Got it? Well, excellent. We'll dedicate an entire future episode to asset allocation, fine-tuning these portions for every stage of life. I mentioned the Bogleheads, and I find their online forum to have helpful threads on these topics, and I'll leave a link to the Bogleheads forum, their wiki, in the show notes. We will talk about all of these options in further depth in future episodes, as well as funds and portfolios that tilt towards small cap value, meaning they have more small companies and value companies than in the general total stock market index funds. So your meal's seasoned, but it still needs the right kitchen gadgets so it keeps simmering while you're off billing hours. 2 tools handle that: total cost and automation. So first with total cost, and this is where we want to watch the hidden menu prices. Expense ratios are just the cover charge. Transaction costs are the corkage fee no one talks to you about. Anytime you buy a mutual fund that doesn't match your broker's logo, expect a toll. So my Fidelity account is a perfect example. If I try to buy Vanguard's mutual fund VTSAX there, Fidelity slaps on a $100 transaction fee. But there's a simple fix, as I referenced before. Buy the ETF twin instead, VTI, with the same ingredients and no commission. Let's also talk about automation. I understand Vanguard now lets you schedule dollar-based purchases into both its mutual funds and ETFs, such as VTI. Fidelity already automates almost everything: stocks, ETFs, even mini portfolios, and Schwab still limits automation to mutual funds. So decide what hands-free means to you, then choose the share class that delivers it. My thought is that the less you have to think about it and the more your finances can be automated, the better. And here's some homework. Log into each account that you have and try to set a recurring buy into your chosen total market or core fund. See if a commission pops up. If yes, pivot. Choose the equivalent no-fee ETF or mutual fund, or mark a calendar alert to place a manual trade if you just can't do it automatically. Consistency beats cleverness every time. So it's time for a quick review of what we discussed. We began with the origin story of index funds, Jack Bogle's folly that became the default for retirement plans once fees plunged to pennies. We peeked inside the pot, learning that market cap weighting and ultra-low turnover keeps costs microscopic while still covering thousands of U.S. companies. We explored J.L. Collins' simple path: own everything, pay almost nothing, and let time do the lifting. We compared total stock market index funds to the S&P 500 and noted their 99% correlation. and saw why covering more companies costs the same yet adds a sliver of long-term upside. We looked into the various ticker symbols offered by Vanguard, Fidelity, and Schwab. We looked at 1 fund, 2 fund, and 3 fund portfolios. Finally, we set things on autopilot, including keeping total costs, fees plus commissions low, and also automating deposits. I just want to mention all the links that I discussed. Bogle history, SPIVA stats, fee schedules sit in today's show notes. Just so you know, in upcoming episodes, we'll dig deeper into mutual funds versus ETFs, target dates funds, and world funds, and the art of asset location so every dollar is housed in its optimal tax shelter. And by the way, if you found this episode helpful, please share it with your friends and colleagues. You can also subscribe so you don't miss future episodes, and even hit the like button if you are so inclined. Remember, financial independence isn't just a dream. Now let's go achieve it. I'm Adam B. Cordover. This is LawyerFi. Thanks for listening. This episode of the LawyerFi podcast is brought to you by Family Diplomacy, a collaborative law firm. We are a Florida bespoke family law firm dedicated to preserving the privacy and dignity of lawyers, doctors, business owners, and executives, and their families as they face divorce. We serve clients throughout the state of Florida, and we have offices by appointment in Tampa, St. Petersburg, and Sarasota. Learn more at familydiplomacy.com or call us at 813-443-0615. You are not alone. We can help. By the way, if you're looking to sponsor the LawyerFi podcast, visit our website at LawyerFi.com.
This has been the LawyerFi podcast. Visit our website and learn more at LawyerFi.com, including information about how to become a sponsor. Watch or listen to us on YouTube, Apple Podcasts, Spotify, and anywhere you get your podcasts from. You can also reach us on Facebook, Instagram, TikTok, and LinkedIn. LawyerFi is hosted by Adam B. Cordover and produced by Eric Sachs. Original music is by Jake Biller. Adam B. Cordover is a Florida-based collaborative family law attorney. He is not a financial advisor, accountant, or tax attorney. This podcast does not provide legal, financial, or tax advice, and is for information and entertainment purposes only.